Five signs of a soon bull market reversal. Some market gurus are starting to worry that the summer rally on Wall Street may be starting to fizzle after stocks lurched from oversold to overbought. Now, Jane Goldman, Chief Investment Officer for Cetera Financial Group, explained that stocks are likely headed for a pullback, even though the economy is in better shape than many Americans might recognize. There's been plenty of great news, but the market needs a little bit of a pause. We've moved a little too fast, too quickly right now, Goldman said in a phone interview with MarketWatch. To support his view, he pointed to a handful of reasons that Friday's slump in stocks might continue into the next week and possibly longer, even though he remains bullish on stocks over a longer time horizon. Defensive sectors back in vogue. Now, cyclical sectors outperformed as stocks rallied in July and early August, but that trend appeared to come to an end this week as defensive sectors retook the lead. One sign that investors are getting nervous is cyclicals underperforming defensive sectors, and we're starting to see that now, Goldman said. Over the past week, consumer staple stocks and utilities were two top performers among the S&P 500's 11 sectors. As a result, the consumer staple select sector SPDR fund, an exchange-traded fund that tracks the sectors, has risen 1.9%, while the utility select sector's SPDR fund gained 1.3%. On the other hand, the two sectors putting in the worst performance were cyclical sectors, materials and communication services. The materials select sector SPDR fund was down 2.4% for the week, while the communication service select sector SPDR fund shed 3.1%. Bond yields are rising. Now, rising bond yields are another sign that the rally in stocks could be about to turn, Goldman said. Higher treasury yields can pose a problem to stocks because they make bonds a more attractive investment by comparison. Now, stocks and bonds often move in unison to start of the year as expectation of tighter monetary policy from the Federal Reserve rattle both assets. But that dynamics appears to have shifted in August. Treasury yields turned higher earlier this month and started rising before stocks hit a rough patch late this week. The yield on the 10-year Treasury note increased 35 basis points since August 1, and it climbed 14 basis points since Monday to 2.897%. Bond yield rise as prices fall, and Goldman and others on Wall Street are now waiting to see if stocks will follow bond prices lower. So is the dollar. Now, rising treasury yields and softening inflation have helped drive the US dollar higher, creating another potential headwind for stocks. The ICE US dollar index, a gauge of the dollar strength against a basket of rivals, topped 108 on Friday, rising to its strongest levels in a month. A strong dollar is generally associated with weaker stocks since it erodes foreign earnings of Americans' multinationals by making them worth less in US dollar terms. Cryptocurrencies are falling. Cryptocurrencies like Bitcoin and Ethereum also lately have been trading nearly in lockstep with stocks, particularly mega-cap technology stocks like Meta Platform Inc. and Netflix Inc. But crypto sold off sharply on Friday, leading some of the people to wonder whether stocks might be next. Now, Bitcoin fell about 9.5% Friday, while Ethereum, the second most popular cryptocurrency, shed about 10%. Equity valuations are sinking with corporate earnings. Another reason to question the rally in stock is that there seems to be a disconnect between equity valuation and corporate earnings expectations. As Goldman pointed out, the price-to-earnings ratio of the S&P 500 has rebounded to 18.6 times forward earnings from a low of 15.5 in mid-June. At the same time, expectations for corporate earnings from the same companies over the next 12 months has declined from $238 to $230. Stocks are rising on falling earnings estimates, Goldman said. Goldman is hardly alone in fretting about rising equity valuations. In a recent note to the bank's client, Citigroup U.S. equity strategist Scott Cronin said that the risk of a decline in corporate earnings heading into 2023 could create a valuation headwind for stocks. We would say that tactically, selling into further strength is justified, he said. Friday's losses in stocks pushed all three of the main equity benchmarks into the red for the week, marking the first weekly drop for the S&P 500 and Nasdaq in a month. The highlights of next week's economic data calendar are expected to arrive on Friday, when Federal Reserve Chairman Jerome Powell is also slated to deliver his annual speech from the annual Kansas City Fed Symposium in Jackson Hole. Economists expect he will use the opportunity to emphasize the Fed's commitment to combating inflation. In addition to hearing from Powell, investors will receive an update on the pace of inflation via the Personal Consumption Expenditures Index, the Fed's preferred gauge of price pressures. The University of Michigan's closely watched sentiment survey, which includes reading on consumers' inflation expectation, is also on the calendar for Friday.